Hello and welcome to the show, Vaibhav.
Thank you very much, Puneet. I mean, it's a pleasure talking to you as always.
It has been a roller coaster ride for the markets for the past few sessions. Are they nervous ahead of the budget presentation, or is it more to do with some global factors?
See, I think in my view, it is more to do with the global factors and primarily what is emanating from the Fed. We have seen Fed being very hawkish in the last few meetings. And the guidance, as now what the street is now taking into account is basically much more interest rates, interest rate hikes during the year, as they were expecting, as against what they were expecting last year. At the same time, the quantitative tightening programs as well is something which has not gone, very well for overall risk assets. So in that respect, we are seeing that reaction more globally.
Okay, so what are the markets expecting from the budget this time around?
So from a budget perspective, I think the continuation of how the policies are in terms of continuing more aggressively on ease of business. I think we need to see a lot more there. At the same time, continued rationalization of income tax and various other, which actually boards into the whole ease of doing business as well. Now, that is one piece. At the same time, continued emphasis with the capex programs, spending will be looked forward to, and I guess that government will continue on that path. They have done a substantial amount of reforms on the supply side. My sense is basically if they continue to go on that path, the market will take it positively. So that is one. Two, in terms of continued emphasis on the COP26 summit in terms of how they are incentivizing the climate change in terms of renewables, focus on renewables, and so on and so forth. I think those are the important statements which will be looked forward from the budget as well. We may see some amount of tinkering in terms of the fuel taxes, additionally, what we would also want to see is basically some amount of rural push, because what we have seen of late is basically there has been some slowdown on the rural economy side.
Okay, so how much room does the government have fiscally to do all this?
Now, we have seen the robust tax collections. If you see the GST or income tax, the tax collections have been pretty robust. So in that light, I do believe that we have room. At the same time, fiscal expenditure should not also be inflationary as well. Is something which we'll have to take into mind, because globally what we are seeing is basically that inflation is kind of spiking up here. We are reasonably good, and we should continue on that path. So while the government kind of keeps on spending and actually making money, which they are, I think fiscal deficit should not be an issue.
So retail investors have been a big part of the market rally since the past 18-20 months. What can they expect in terms of budget proposals?
See, from a retail investor's perspective, I think whatever needs to be done to grow their investment pool, I think is pretty much in place. The only thing which they would ideally not want is any change to the existing paradigm or existing environment or ecosystem. What is very encouraging from a retail perspective is basically that even after the kind of market volatility which has been there, their participation on the markets in terms of their investments, both directly or indirectly through vehicles, have been pretty robust. Which also we have to understand that in the last 3 months of FPI sellings which have happened, I think a lot of that kind of has been absorbed by the increased participation of retail, an increased percentage of household savings towards these kind of instruments as well. My sense is basically this is a secular trend. I think we should continue on that path.
Okay, so how should investors position themselves in the market ahead of the D-Day?
My sense is basically budget is an important event, no doubt about it. Continuity in terms of the policies will be well appreciated. And once we sort out from a Fed perspective then probably it is 1/4 of volatile markets. But then once we see some amount of course correction there, is we can see the remaining 9 months of the second half to be very good for emerging market basket, including India.
Thank you, Vaibhav, for joining us today. We hope to see you soon.